What's up, everybody? Michael here. So I have been very curious as to why Fed Funds Futures is predicting a rate cut. I'm sure you have been too. Now in this video, we're going to be exploring why they see a rate hike to come. We're going to be sharing some intriguing technical charts and revealing some surprising insights about volatility and credit spreads. We're also going to get into daily expected moves and see everything from a technical standpoint to set our day up for tomorrow and the week. You're watching the Stock Market Brief Show. My name is Michael Silva. If you haven't done so already, hit that thumbs up. That's how you sponsor this video. It's greatly appreciated. And subscribe if you haven't done so already. Let's get into it. Welcome back, everybody. Michael Silva here. I'm feeling pretty jacked right now to go through this video, or it's probably just the caffeine running through my blood system right now. Now, the federal funds futures. This is not a small amount of money being traded, and the market likes to be forward-looking. And what they've been telling us is they see rate hikes coming, that Jerome Powell is going to pivot. Now, Jerome Powell himself said that's not the base case, which we discussed in prior videos. But if these guys, these traders, the Fed Funds Futures, if these are correct, what are they sniffing out? And that is a big thing to talk about, because during a rate hiking cycle, what comes after is a potential rate cutting cycle. And as we've seen, rate hike cycle back in 2004 to 7, right? And then here, big rate hike cycle with some insane movements to the upside in rates. When we went through the rate cut, we knew that what? Well, the market did not enjoy that period. It did not enjoy that period. If we start rate cutting, is the market, the Fed Funds Futures, are they sniffing something out here to come? That's a possibility. And we, also talked about this inverted yield curve when it uninverts, and when it uninverts, it's not typically great also for the market. Now, today was an interesting day. Energy was up, that led the way. Energies came off a little bit, and now we're starting to see this reflexive type of bounce in oil. But what stands out to me the most is there wasn't much price action traded. They're relatively flat on the day if you look at all the index products. Tech got hit, one of the worst. But take a look at the VIX. The volatility index, the VIX, came down about 3%, which is not a small move. It's a pretty decent move to the downside. After this pop-up over here, the VIX has been coming off. But this is where it gets a little interesting, is if you stop looking at just the VIX and you look at something, like VIX futures, the volatility index futures, and you take a look at the contracts here, you can take a look at the most active one here. This is the contract that's trading in April right here. And you could see the last time that I pulled this, it was at 21.68. And then you could take a look out further into the curve in May, and that is trading right at 22.65. Okay, so what this is telling me here, first and foremost, this is normal. Okay, this is known as contango, where you have 21.68 is trading less than looking out to the next month, which is normal, right? Because the markets typically say, hey, yeah, things are good here, but we see more risk into the future. That's normal. Okay, that's where the curve goes like this, or the term structure goes like that. It gets a little bit different here, though, if we go into backwardation, where all of a sudden the April contracts start trading higher than the May, or potentially even the June. That's when the term structure would look more like so, boom, boom. And that's telling us, hey, there's a lot of risk here. And what I want to call out is, when you really look at this, you're looking at April being traded at 21.68, and you're looking at 50 days out, right? The May contract's 22.65. It's not necessarily too far in distance away. So to me, this tells me, hey, to go into backwardation, it's not going to take much. And if you take a look here, what happens when we go into backwardation? Well, just take a look at these times where we see massive spikes of backwardation, where we see a lot of forward risk. Well, you can see January 2018, right? If you remember that, if you remember 2011, if you remember the great financial crisis, if you remember the pandemic, what happened to the stock market during those times? This is what the term structure looks like in backwardation, where you, like I said, you have the first month or the nearest month trading much higher than the months that follow. And this is what contango looks like here, which is much more normal, looking out, seeing risk in the potential future. So if I look at the current term structure, it is normal, it is in contango. But what I want to do, like I said, want to call out here is that it's not like it's a huge difference here. So if something were to happen, we can very quickly see backwardation. And I want to bring you to this here. This is the zones, okay? This is interesting indicator that I use on a wide range of products to really get a good sense as to say, hey, are things oversold here? Are things overbought? And one of the things that I share with the Discord on this zone document is the volatility section. I do global, I do commodities, I do all kinds of stuff on this, and I just supply this spreadsheet like so. But on the volatility section, I just want to call out that if you do look at the VIX futures down here, you're starting to see here we close at 2170, at least when I had this pulled up. And then the low end of this zone is at 9182. These are dynamic. They're changing. They're based off of fractal math, using math from Benoit Mandelbrot. Originally, this indicator was created by Joe Catanzara, and it's a very helpful tool. This, by the way, this is something that I do. I extract bulk data from it. So you can't just find this. I'm just extracting data from a large data set and then putting it on this Excel sheet. So what I'm calling out here is they are nearing their low end. And if this is the case, if we start coming down to this area, be careful, because that can mark an area where we can potentially see volatility start to lift back up, as we've seen volatility in recent days trending, right? We saw, a low, a higher low, potentially a higher low, you can see in higher highs. So a spike back up could very well take place. And I'm also starting to notice here on the range, this just helps me quickly identify things at the low end of their zone. You can see here, this right is the VIX, okay? So the VIX is coming down to the low end of the range. It closed at 1997, and a low end is at 1811. And then I take a look at the one right below that, that's VXN, that's NASDAQ volatility. So NASDAQ volatility also is even closer. So we close at 24.5, and the low end on NASDAQ volatility is 23.62. And that's still relatively high for NASDAQ volatility, right? It's still in the 20s. What would concern me more is if we see this tagged and potentially see it go 25, 30 or even higher, where you can really see tech stocks just get brutally hit. And we saw that today. We saw them get not quite brutally hit. We'll get into that momentarily on those charts. Now, this is the MOVE index. This is looking at bond volatility. And this is, once again, I'm going to keep bringing this up, nothing to just ignore. Okay, bond volatility is, as it stands right now, above where we were right here in the pandemic. And if you look farther to the left of the screen, this is the great financial crisis. So bond volatility is moving up. So there's some interesting stuff taking place here. But let's look even further. Can this potentially go higher? All right. So if I take a look here at this chart, I'm looking at the MOVE index versus corporate credit spreads. Now, this is where it gets a little interesting, folks, so pay attention. The MOVE index right here is in red. So we've already know, yeah, it's moving. It's currently what? It's currently above the pandemic. We just talked about that. If you look to the left of the screen, this is the great financial crisis. Now, what I find interesting here is credit spreads isn't really following it to an extent that it typically does, where you see stuff like the great financial crisis or what happened during the pandemic. So what this could potentially be telling us at this time is, hey, guess what? We may very well see credit spreads blow out, which is not good for the overall market. And that's a possibility, trying to crack this mystery over here as to why they see the Fed reducing rates. Okay, so it's a possibility. It's something to be at least concerned of, to be aware of. Doesn't mean it's necessarily going to happen. Now, I want to overlay that credit spread with volatility, right? So what typically happens if credit spreads move up? Well, you typically see volatility go up. And when volatility goes up, remember, volatility, it's plus or minus. Now, typically when you get a spike like this, it's not overall that great for the market. But remember, volatility, it could go both ways. So you'll see typically, and I don't have a chart to show this, but if you see like a rate of change on a one-day basis, on a long-term chart, what you'll see is during times of high volatility, you'll have the biggest up days and you'll have the biggest down days, meaning like that's typically bear market style. And we've been seeing some very, very large swings back and forth in these index products. Now, if we take a look right over here, what I'm noticing is on the blue, this is the high yield credit spreads, and volatility is backing off quite a bit. And really, credit spreads isn't telling us that same story. So maybe credit spreads come down, or because it's holding up here, it might be telling us, hey, no, volatility is near the low end of its zone right here. It's going to probably start coming back up. Well, I don't know, but that's a possibility. And then if I take it one step further, if we take a look at credit spreads, high yield credit spreads, which is in blue, This is also a very concerning thing. When you start to see credit spreads rising or trending up or spiking to the upside, what typically follows shortly after? The unemployment rate. So as credit spreads start to blow out, we can see unemployment rate rises. And you can really see that here right before the great financial crisis. You saw credit spreads blow, boom. And then shortly thereafter, unemployment, right, the lagging indicator, it followed shortly after. And right here in 2020, you saw boom to the upside there in credit spreads, high yield, and unemployment shot through the roof. Why am I calling this out now? Well, you can see credit spreads, they are starting to move up and they are starting to trend right here. And unemployment, well, it hasn't even budged yet. Or has it? And it's just not been reported. Well, take a look here. 2023 tech layoffs, the running total on the full month so far, meaning January and February, is totaling 121,205 layoffs. Now, that doesn't include this month. What happened this month so far? Lucid recently announced laying off 1,300 employees. We have GitHub reducing their staff. We have Disney. We have Salesforce, Accenture, Indeed, Roofstock, Twitch, Amazon, Livespace, Course Hero, and then we have Microsoft, Meta, and so forth down the list. We have much more unemployment coming off. So, as we're running into earnings season right now, this is where it gets very interesting. The federal funds rate, they're starting to see, hey, we're going to start seeing the Fed reduce rates. We've seen volatility increase in various aspects. We're seeing companies starting to lay off people. And I think who said it best here was on this interview on the tape. I'm going to play this quick clip because this is where it's going to get very important coming into this next quarter. It has to do with earnings season. Here's that clip.
So you look at the big tech companies that have cut a lot, even the small tech companies that have cut a lot. This earnings season will be the time when we decide whether or not they cut enough, right? Was it enough to protect their margins? Was it enough to protect the lower revenue growth that they're seeing because inflation has come down? The other thing I would say about earnings season is that if you look at the calendar, one of the first banks to report is First Republic on April 13th, I believe. BlackRock reports that day, and then the rest of them come in within the next few days. So that's going to be a volatile time. And the other part, if you talk about just how the financials recovered after the crisis, think about it too. I know I'm a macro strategist, so I'm going to bring it there. But if you look at something like the unemployment rate, things crash in a straight line. They recover in a very slow grinding line. So this is going to be all about the slope of the line, which if you're a math geek, it's the rise over the run, right? When things crash, they go down in a pretty fast fashion, and you can connect the dots from 1 to 2, and it's just one little straight line. When they come back, it's this kind of staircase back up, depending on the indicator you're looking at. That's how this is going to go. And at least in my opinion, that's how this is going to go. We haven't seen that big crash yet. We've seen it in little parts of the market. We haven't seen it broadly, and we haven't seen it in economic data. I think we are on the verge of seeing it. And frankly, I'd rather let's just get it over with, right? Just be done with it. Like almost in April, let's just get it done and then start that slow grind back up.
So there you have it. That was Liz Young discussing that, how important this earnings season is going to be. Did they cut enough? Did they reduce their staff enough? Is it going to help out margins? So it's going to be incredibly volatile, incredibly important to watch. And there's a lot of warning signs here telling us to just be on guard. Once again, plus or minus, right? Volatility can go for us and it could go against us. Whether you're short or you're long, right? It can hurt either way. So it's something that we need to just be careful for. Let's go ahead now and hop into more technical charts and get a good idea as to where the market may be headed next. And also, I have something interesting around home builders too I want to discuss on today's show. If we take a look here, this is known as Bookmap. I always forget to mention this, but Bookmap offers my subscribers a discount, so I put that link down below there in the pinned comment section. This is software that I use on a daily basis to intraday trade. It allows me to see some key levels of liquidity, like the order book. It's like taking the blindfold off. If you've ever seen those screens that flicker numbers back and forth, they look kind of like, the level 2s where you see the bid and ask. It's basically putting the order book in a heat map form, which makes it a lot more simpler for people like me to trade. Now, this was yesterday of what to expect as far as ES goes. So the S&P 500, we're looking at ES. We said there's an upper EM right here, lower EM. The EM is expected move. That's based off of implied volatility, yada, yada. What did the market do? The market did this. The market came down, tagged the lower expected move, and we started bouncing from that level. So these levels, right? This is why I share this with the Discord. This is why I share it here for free on YouTube, because they are an incredibly important tool for understanding what does the market perceive as risk looking into the future, whether that's 1 month, 1 quarter, 1 day, or 1 week. Okay. You can see we tagged it and we started finding buyers from that area. Now, if I go into what does Bookmap look like going into tomorrow, and what is the expected move for ES? What are some key levels? So the upper expected move brings us to just over 40.35, and the lower expected move, it brings us to just about 39.75. Now, both of these levels are going to be key to note, because not only is it the options market pricing these in, but you can see here on the order book, there's actually a decent amount of contracts that came in there. After the close even took place. So this was today's trading action after the close. We still see orders hanging out at 40.35 and 39.75. So these could act as potential areas of support and potential resistance. You want to see how price acts around those areas. But say if we hold the daily VWAP, maybe, and we see higher lows and price contracts, maybe that opens the door for, hey, we may be able to take a long shot up into that upper expected move. Or maybe the daily VWAP gets breached, and then we say, okay, well, if that's breached, that opens the doorway down to the lower expected move. So there's a bunch of different ways you can use this. I know of traders that trade options. I trade only equities, but they become premium sellers at, weekly expected moves or even daily expected moves. So let's hop into the SPY. This is the daily time frame, and I want to call out here, it's a moment to be patient because we're in what's called just chop, right? The market is pricing back and forth, trying to look for a way to break free from its little cage over here. And as it stands right now, we can anchor a VWAP from this little swing low and this previous swing high, and you could see we see expansion, and then the market starts to contract. Remember, expansion leads to contraction, contraction leads to expansion. So what do? Well, you can see here there's a key level, 400. You want to see price close above this anchored VWAP or above 400, and then they open the door to come where? To this prior swing high right at around 415. Now, on the flip side of that, we also potentially need to be careful if price gets below this key level, which is right at around 390, which has been a very key level through the course of this, 3, 4, 5 months or so. The market's been kind of just chopping around. If we start cracking down beneath that, that opens the door lower to around that 380 area. There's also another anchor VWAP on my screen. That's the year-to-date anchored VWAP. So if we do, like I said, start getting above that, that means what? It means that the average buyer will be actually in the green based off of that time and volume, and that would be a positive potential shift there in the overall markets. If I show this indicator, this is known as the 5, 10, 20 timer, and it's just showing us right now these moving averages, the 5, the 10, and the 20, and you can see that they're starting to coil up very tightly, and when we get tight coils, it leads to explosive type moves. You can see they coiled up over here, we saw an explosive move down, they coiled back over here, we saw an explosive move up, we coiled down here, we saw an explosive move. So chances are in the very near future, we're going to be breaking from this chop box and seeing either an explosive move to the upside or downside. Now, if price starts breaking up through these levels, as we stated, around that 400 on SPY, 4,000 here on the SPX, that can start a potential change in trend where the 5-period moving average is above the 10, and then it gets above the 20, and then they start spreading out, and you start to see higher lows and lower highs and such. One thing to call out too is the possibility for a bear flag. It's still there in the market. Today, you can see volume starting to dry up. So as price is contracting, you can see volumes contracting too, leading me to believe that we may see an explosive volume day in the very near future. Remember, expansion, right, even with volume, leads to contraction. Contraction can lead to expansion, including in volume. Now, if we take a look at the 15-minute time frame and the daily expected moves, these were yesterday's daily expected moves. Price came down into it, not quite touching it, and we started to see a bounce where right back to that 5-day moving average, and we're still below the week-to-date anchored VWAP. So as it stands now, you want to see these reclaimed. As it stands, like I said, it's bearish as it stands right now. You want to see price to get back above it. You want to see it hold, put in a higher low, maybe break through that and start trying to buy into this upper levels over there. But let me update the chart to show you the new daily expected moves. 396864 to the upside, 39256 to the downside. This is a potential. We might be building out somewhat of a bull flag right there, but if we breach this low over here, that definitely opens the door to continue the lower highs that we're seeing take place in the SPY. I want to show something else here now. This is looking at the housing index above us and the S&P 500 below us. There's something very interesting going on that I wanted to play out here. Now, this helped actually show the 2008 top, where housing typically tops before the S&P 500. And if I look back here to 2021, this is where housing peaked and the S&P 500 continued to rise, and then you made a new high over here where actually the housing market, looking at the housing index HGX, did not actually make a new high. And that right there was a pretty gnarly divergence, and this is the same thing that happened back leading up to the great financial crisis. And then you could see this started to move down and the S&P 500 started to follow. Now I want to zoom in closer to this area of the chart. So if I do that, what I want to show you here is the S&P 500 has been kind of moving itself higher while the housing index hasn't been following. And if you remember what I say, the markets move between expansion and contraction. So as it stands right now, housing index is tightening up very, very tightly. And these type of things can cause explosive moves to the upside, explosive moves to the downside. So if this starts falling, even housing goes up and this starts moving down, this could be giving us insight that, hey, the SPY might not have much gas in its tank and it's going to shortly there follow, okay? And if I come in over here to the XHB, this is an ETF, a home builders ETF. You can see that we did break down through this upsloping trend line. Okay, and if you were to do a measured move on this, it would be measuring it to the trend line from the high point here, and it'd be coming down the same distance. So whatever, 63 to roughly 73, so a $10 swing. 67 would be down to 57 right down here would be a full measured move. Okay, so you can see here, it's back below the 50-day moving average. It's back below the 20. You have the 20-day or the 200-day sloping up. So a potential a move down to 62 is possible, but for a full measure move, it would be around that 57 marker. Now, I do see the MACD starting to curl itself over. So this could just be one fake out and we start to head higher, right? You might look at this and be like, it's a bull flag, Mike, and then it's going to go head higher. That's always a possibility too. I just want to call out that, hey, volume's contracting, price is contracting. It's likely to see some sort of explosive move here in the near future. That's all I got for you on today's episode, everybody. Hope you all have a wonderful night. See ya later.